If you are approaching retirement or you are already there, there's a deadline the IRS has put on your retirement money that most people don't fully understand until it's too late. It's called a required minimum distribution. And if you miss it, you could face a 25% penalty on the money you were supposed to take out. In this video, I'm going to walk you through exactly what RMDs are, when they kick in, what happens if you miss it, and watch until the end because I will show you what you can do now to take control of them before they take control of you. My name is Eric Schrum. I'm a CFP professional and owner of Schrum Private Wealth Management. Let's jump in. So let's start at a really important place. What is a required minimum distribution? Here's the simple version. When you put money into a traditional IRA, 401k, or other tax-deferred account, you received a tax deduction. The IRS was basically saying, we'll let you defer taxes on this money, which is genuinely helpful because that means you can grow that money tax deferred over decades. But the IRS wants their cut eventually. RMDs, required minimum distributions, are how the IRS enforces that. Starting at age 73, you are required by law to take a minimum amount out of your tax-deferred retirement accounts each and every year, whether you need the money or not. And those withdrawals get added to your taxable income for the year. So even if you don't need cash flow from your portfolio to that extent, you're still going to be required to take that money out and pay taxes, even if you weren't planning on it. Next, I want to tell you what accounts are subject to RMDs. And I'm going to make this very short and sweet so that you have it and you can reference it. Okay, so these are required to take RMDs at your required minimum distribution age. Okay, number one, traditional IRAs, 401k plans, 403b plans, 457 plans, SEP IRAs, and simple IRAs all require you to take money out under RMDs. Here is a very important point though. I'm now going to tell you what accounts are not subject to RMDs, okay? 3, taxable brokerage accounts, Roth IRAs, and Roth 401ks. Some very important points here. Roth IRAs and Roth 401ks, as long as you follow all the rules with Roth accounts, that money comes out tax-free to you. So actually no taxes paid. With taxable brokerage accounts, they generally will fall under capital gains tax. And so that's actually a lower rate than income tax rates almost always. So very important to understand what accounts are actually not subject to RMDs. We're going to get to a very important point later in the video about how you can leverage these accounts to really get ahead of the RMDs before you have a huge tax bill. All right, so when do RMDs actually start? The answer you need to pay attention to, okay? So under current law, the RMD starting age is 73 years old. However, there are a few very important things you'll want to know about this starting age. So first, you technically have until April 1st of the year after you turn 73 to take out your first RMD. So for example, if you turn 73 in 2026, you could wait until March of 2027 to take that first RMD out, but you'd still be required to also take that 2027 RMD out, even though you delayed your 2026 first one. If you're curious what I tell most clients about starting your RMDs, this is the advice I generally give. Start your RMD in the year that you actually turn 73. Don't delay it, because what this does is it avoids having to take the equivalent of 2 RMDs in 1 year, which can really, jack your taxes up into higher tax brackets instead of spreading that income out over multiple years. That's not fun. Next, after your first RMD, you're required to take that RMD going forward by December 31st each year. Now, clients often ask me if there is a required month they must take their RMD out each year once they start RMDs, or if it has to be taken like the same time each year. And the answer is actually no. As long as the RMD amount comes out by December 31st each year, the IRS, they just don't really care how you handle it. You can take it all out in December, December 30th, which I don't recommend leaving that late, or you could just spread it out across the year as part of your retirement withdrawal plan out of your retirement accounts. Finally, when it comes to RMD starting, while the RMD age currently starts at 73 years old, if you were actually born in 1960 or after, the IRS is giving you a break and they are increasing your RMD starting age to age 75. So right now, if you were born pre-1960, your RMD age is 73. Born 1960 or after, it's 75. All right, now let's talk about the penalty and what happens if you actually miss your RMD, which I highly recommend not doing. So if you don't take your RMD or you don't take enough of your RMD amount that you are required to take, well, frankly, it's not pretty. The IRS is going to penalize you 25% of the amount you should have taken out. The good news is, if you can think of it that way, is there is a grace period. So if you realize that you missed your RMD for the year and you correct it within 2 years, that penalty drops from 25% down to 10%. So it's still not ideal. It's still not something that you want to happen, but they will give you a break from that steep 25% penalty to still a steep, but not a steep 10% penalty. Now, here's where things get tricky. If you miss your RMD over consecutive years, let's say you just didn't know an RMD was a thing or you put it on the back burner, you could be looking at multiple 25% penalties stacking on top of each other. And this is why it's so important to be on top of your retirement planning or work with someone specializing in retirement planning so these very important things don't fall through the cracks. Finally, what are strategies you can employ to take control of RMDs today? Now, we're going to stay very high level here. And if you want to have a deeper conversation about any one of these, you can reach out to us in the link in the description. So number one, Roth conversions. And this may be the biggest lever you can pull to lower your lifetime tax bill and avoid crushing taxes sometimes from your RMDs. You're essentially, with a Roth conversion, moving money from your tax-deferred accounts to a Roth account today in order to get ahead of your RMD obligations in the future. Now, this is a very powerful strategy, or it can be, but I really recommend working with a skilled financial planner to ensure it's being done correctly, because there's a lot of nuance that you do not want to get wrong with Roth conversions. Number two, managing income to avoid Medicare IRMA charges. Now, here's a downstream effect that often surprises people. Your Medicare Part B and D surcharges are based on your income in retirement. And if your RMDs push your income up above IRMA thresholds, you can face often significant increases how much you pay for Medicare. So people often will look at their pension, Social Security, maybe withdrawals from IRAs normally, but they won't take into consideration RMDs that can push you above IRMA surcharges. Number three, QCDs or qualified charitable distributions. And I love this strategy. If you're charitably minded, at age 70 and a half, you can actually start making charitable gifts directly from your retirement accounts. Now, this is extremely powerful because it allows you to exclude those charitable donations from taxable income entirely, and it allows you to satisfy your RMD for the year. Even better, the QCD limit, the qualified charitable distribution limit, is very high. So you can donate up to $111,000 per person, or you're looking at $222,000 per couple this way each year, and just get that totally out of your taxable assets. In closing, RMDs are one of the areas of retirement planning that people tend to ignore until they can't. And by then, you've already lost many of your options. If you want to talk through how RMDs will affect your specific situation, I do offer complimentary consultations for people who are approaching retirement, are in retirement, and have maybe around $1 million or more in retirement savings. You can email me at eric@schrumpw.com or just click the link in the description to schedule a time on my calendar. And I'll see you in the next one.
The content provided is for general information and educational purposes only and should not be considered a recommendation of any particular strategy, investment product, or investing advice of any kind. Content is not intended to be and should not be construed as legal or tax advice and/or a legal opinion. Please consult a financial professional for your specific situation. Investing involves risks, including the loss of the entire principal. Past performance does not guarantee future results. The views and opinions expressed here are of the author and do not necessarily reflect the opinion of Schrum Private Wealth Management, LLC. Investment advisory services offered through Schrum Private Wealth Management, LLC, an SEC-registered investment advisor.